Credit default swaps. The name itself sounds kind of complicated, right? Maybe a little intimidating. But what if I told you they're basically just a fancy insurance policy? Well, that's what we're going to do in this explainer. We're going to pull back the curtain on this powerful financial tool. We'll break down what a CDS actually is, how it works, and yeah, why you should even care. So let's dive in. At the end of the day, a lot of high-level finance boils down to some pretty simple questions. So just imagine you've lent someone money. Doesn't matter if it's a friend or a giant corporation. What's your number one worry? It's simple, right? What if they can't pay you back? That possibility, that chance of not getting your cash back, is what the pros call credit risk. And that is the exact problem a credit default swap was invented to solve. See, every single loan is a promise, but, some promises are a whole lot riskier than others. So let's first dig into that fundamental risk that's right at the heart of all lending and borrowing. So you're holding this risk. What do you do with it? Well, a credit default swap is a financial gadget designed specifically to move that risk around. If you own a company's bond, you're on the hook if that company fails. A CDS lets you package up that worry, that risk, and just hand it off to someone else who's willing to take it on. For a price, of course. It is a literal transfer of risk. Okay, so what does this risk transferring tool actually look like? The best way to think about it is as a financial safety net. Let's take a look at how one of these contracts is actually put together. And here we go, the formal definition. A credit default swap, or CDS for short, is a contract. It's an agreement that gives you a payout if a specific company or even a whole government fails to pay its debts. We call that company the reference entity. So really, it's protection against a very specific, very bad thing happening. And just like any deal, there are two sides to it. First, you've got the protection buyer. This is the person or institution that's worried about a default, so they pay for this financial safety net. And on the other side, you've got the protection seller. They're the ones collecting those regular payments. And in exchange, they promise to cover the loss if that default actually happens. It's a classic trade-off between risk and reward. So now we know who's in the game. Let's follow the money and see how it actually moves between them. This is where you can really see the mechanics of the CDS come to life. First up is what's called the premium leg. This part's pretty straightforward. The protection buyer makes a series of regular payments to the seller. The insurance analogy is perfect here. It's just like paying the premium on your car insurance. You pay a steady fee to get some peace of mind. And this is what the buyer's paying for, the protection leg. Now, this isn't a regular payment. This is a potential one-time payout. This cash only flows from the seller to the buyer if, and this is the important part, if that default we talked about actually happens. This payout is the whole point of the contract. Okay, so what happens when that potential disaster becomes a reality? Let's walk through the exact moment a CDS gets triggered and has to do its job. The trigger for all this actually has a specific name, a credit event. It's the official term for the default or some other bad financial event that forces the protection seller to make good on their promise. As soon as a credit event is confirmed, the contract kicks into gear, and it's time to figure out how big the payout is going to be. Now, here is a really important detail. When a company defaults, its debt hardly ever becomes totally worthless. There are usually some assets left, something to salvage. The recovery rate is the percentage of the original loan that investors can still get back. So, for example, a 40% recovery rate means you didn't lose everything, you still got 40 pence back for every pound you were owed. So, how do we figure out the actual financial damage? Well, it's a super simple three-step process. First, you start with the total value of the debt. Then, you subtract whatever you managed to get back, that's your recovery rate. And whatever's left over, well, that's the actual loss that the CDS is supposed to cover. Simple as that. And this brings us to a nice, clean formula. The loss given default, or LGD, is just 100% minus the recovery rate. So if the recovery rate is 40%, the loss is 60%. It's really that straightforward. And this is the number that's going to determine the final payout. Okay, so we've covered the players, the payments, the formulas, the whole shebang. Now, let's put it all together with a real-world example to see exactly how this works. Let's imagine our reference entity is the good old ACME Corporation. An investment fund owns a bunch of their bonds, but they were smart and they bought a CDS just in case. And, well, the worst happens. ACME defaults. The total face value of the bonds that were insured is £195,000. In CDS lingo, this is the notional amount of the contract. This is our starting point for the whole calculation. So after the default, the accountants go in and figure out that investors can get back 40% of their money from what's left of Acme. So our recovery rate is 40%. All right, time for some simple math. Using that formula from before, we take 100%, subtract that 40% recovery rate, and that gives us a loss given default of 60%. This is the chunk of the investment that really just vanished. And here's the final step, the moment of truth. We take that 60% loss given default and multiply it by our original notional amount of £95,000. And the result? The protection seller has to pay the buyer £117,000. The CDS did its job. It perfectly covered the capital that was lost.
All right, let's do a super quick review of the key terms just to make sure they stick. First, you've got the notional. That's the face value of the debt being insured. Then the reference entity. That's the company you're betting against. You've got the premium leg, which are those regular insurance payments. And finally, the protection leg. That's the potential big payout from the seller. If you get those four, you've got the whole structure down.
So we end up right back where we started, but with a totally new perspective. A credit default swap makes risk, the actual chance of failure, something you can package up, transfer, and sell like a product. It lets risk flow from those who can't stomach it to those who are willing to hold it. And that simple fact raises a huge question to think about. When you can literally buy and sell the risk of failure itself, what does that change about everything?